Nirmal Jain of IIFL is up next to talk about the same issues. Morning, Nirmal. We are now at a critical juncture. This morning we have traded quite a bit below 5,500. Is the long-standing range in real threat of breaking down?
It's quite under threat of being broken down. In fact, because whatever cues we are getting from macro or all the factors that can impact market, they aren't positive. We have been talking about it, that high interest rate inflation, that is choking the private sector investment, and on top of that we have a current account deficit for which now government as well as central bank seems to have run out of options. I mean, unless they increase customs duty or they come up with sovereign bond, now custom duty will have impact on the economy, which is negative, the hike in custom duty. So at this point in time, we are looking at a situation where GDP for the year can go below 5%. So other than monsoon, most other macro variables aren't looking positive. So at least in the near term, at least in the foreseeable future, if something, unless something dramatic happens, the sentiment is subdued. I'm not very pessimistic in the sense that not that market will crash or we are into a market which can go much further down or rupee can further crash, because as I mentioned, that there are certain things which can go and there are certain things the government will have to take some action now, and in fact they have been discussing. So most of these proposals are on their table. So I think it's just a matter of time that some corrective action is taken. But for the time being, there are very few positive cues and a lot more negative ones.
What if FIIs begin to take a dim view on India, Nirmal? Because everybody seems to be hoping that for some reason they will not sell and therefore the market will not tank. Do you think the way the market is these days, in terms of how shallow it has become, it can even absorb $4-5 billion of FII outflows, which can happen because of them taking a negative view on Indian macro even for the next 1 to 2 years?
I don't think at this point in time market has capacity to absorb $4 to $5 billion of FI flows, outflows. And maybe even FIs know that. Most of the fund managers are Indian, or they know India very well. So they know how hollow the market is, that if they press the sell button, then they know that prices can crash and there won't be any buyers. Having said this, only one very important feature of FI investment in the last 3-4 years, and therefore their holdings at this point in time, they are mostly concentrated in FMCG, pharma, IT, and a little bit in private sector banks and NBFCs. And in last few weeks, they have sort of exited at least part of their holdings in private banks and NBFCs, and now maybe they are looking even at FMCG sector to lighten their portfolios. So if you even look at indices, they've been held up by just these 3-4 sectors and maybe 5 or 10 companies. So FIs, at least the ones that are more, they trade on the fringe, or the hedge fund ones, or those who can be very quick traders, they are as of now invested mostly in sectors that are doing well. So they already hedge themselves against the negative economic growth, and therefore I don't see that there will be a trigger for any significant outflow. But at the same time, what is happening is that they aren't buyers anymore, and they are marginal sellers, which itself is not a good news.
Do you think they could be selling down some of their holdings like ITC at 320, L&T at 780, ICICI Bank, those kind of long-term core holdings? Could that be coming under pressure? This morning, Morgan Stanley has cut its weightage in HDFC and HDFC Bank after many years in their Asian portfolio. Do you think some of these old blue chips could come under pressure?
One can't rule out, but heavy selling or large ticket selling will happen only if there is a big negative event outside or something that triggers this. So if there's some crisis or some event that happens in the US or developed world which make emerging market funds to shrink, or something that happens in India, maybe a war kind of a thing, or that the threat becomes more serious. So that kind of an event can trigger, but in a steady state scenario, I think more or less they know all the factors, and so the investment has taken into account those things. So I would say that unless there's another event which we can't foresee today, or which we haven't already factored in, the selling will be small and marginal. I don't think there'll be large ticket selling as such.
What is your own take on how long it will take to fix this, Nirmal? Because people were getting a little hopeful that maybe by the second half of this year, things will start picking up and then equities will start to look up again. Are you less hopeful on that front?
I think, most of the hopes have been belied. So I'll be very honest that now, just like most of us, I'm also losing hope and thinking that it may take at least a year more when election outcome becomes clear or election comes closer, and people, at least in markets, when they look ahead, they get optimistic and they try and look up, see that things will change after election. So that is one hope. Another, at least one positive development is that at central bank, we now have a young governor who probably will bring in fresh ideas, new thoughts. But that has to be complemented with some solid action at government front. Otherwise, we saw that the rupee appreciated yesterday, but again gave up all the gains this morning because people realized that the governor himself cannot do everything. And so I think the more likely scenario is that we may have to wait for 6 months to a year when the elections get closer and people see that that outcome has some much better hope than what we had in last few years.
What is your approach to fixed income investing over the next few months?
We are still holding on because of course there have been some losses, but the losses also depend on what kind of tenure and what is the time frame you have, because say you invested for 10 years and you hold to mature and get the redemption, then you really earn interest income and you don't have capital losses. So we think that interest rates will head down as we see macro numbers getting negative on GDP, industrial growth, and with the new governor there will be new thinking. And my thought always has been that while it is important to contain inflation, but RBI's monetary policy cannot do anything when it's caused by supply side constraint in say food and as well as fuel prices, which are beyond the control of monetary policy, more driven by global commodity prices, then at least we shouldn't do something which has a more a negative side effect on growth. So I think interest rates might have risen in last few weeks, but we are still advising our clients that hold on to it. I think the cycle may, the interest rates may peak out soon, and it's just a matter of few weeks that we'll start seeing, correction again there.
So what's the worst you can see for the Nifty in the course of the next 3 months?
The worst, if you ask me, it can go down to level of 5,000, 4,900 also. I mean, that can't be ruled out.
And the best?
Best case scenario is that it will remain here, and if there is, okay, let me paint the best case scenario that monsoon news is very good, crude oil prices go down, the new RBI governor basically takes a very strong view on the interest rates and tries to focus more on growth, and government gets its act together and clears all the stalled projects. At the same time, they are able to do something about this current account deficit. They can probably come out with some sovereign bond which basically helps the rupee. In that kind of scenario, Nifty can go back to 6,000 level.
Thank you, Nirmal. Good talking to you as always.
Thank you
Thanks
so
for
much.
stopping by today.